But how better to close out the day than with an economic update that traverses all of the themes we've discussed today and more. And who better than to present that than Jarek from Westpac. Jarek Kowcza is Senior Economist with the Westpac Group. I mentioned they're my favourite bank. He supports many of their businesses, including the cherished BT brand. And prior to joining us, worked with Treasury in Canberra for 8 years, specialising in tax and macroeconomic analysis and banking and financial systems policy. You'll be pleased and relieved to hear that he holds a Bachelor of Economics because, of course, he's here to deliver our economic update. Thanks.
Thank you very much, Jason, for that excellent introduction. And thank you, everyone, for having me here today to speak to you. I know it's been a really fantastic conference, and there's been a number of really excellent sessions earlier today. I think, one of the sessions that sort of stood out to me was earlier today when we had the session about Australian equities. There was a comment made that you should really ignore the economy and not really think about what's going to happen over the next 12 to 18 months or whether we're going to go into a recession or not, and think about the long-term fundamentals of equities, which, is a very good point, but a little bit difficult to hear when I'm actually here to talk to you about the next 12 to 18 months and what our outlook is for Australia and the global economy and whether we think Australia will go into a recession. So I know that's a bit of a hard act to follow, but, hopefully you'll get a lot of insights out of this session today. And I think the important thing to gather is not just a forecast or a number. I mean, ultimately you can pull that out of Bloomberg or consensus economics or so forth. But it's really to talk about what are some of the underlying drivers and themes that we're seeing in the domestic and global economy and how those themes might sort of evolve over time. So I think that's really what I'm going to be focusing on talking through today. So let's just take a little bit of a step back and actually just remember where we've come from and why we've actually got a lot of these issues that we're facing at the moment, particularly on the inflation front. And this point has been made through some of the sessions today as well, that during the pandemic we had incredible levels of stimulus, not just from fiscal authorities, but also monetary policy authorities. Of course, interest rates were zero. Quantitative easing programs were all the rage around the world, including also yield curve control policies, and governments, spent significantly increased their debt to GDP ratios. So this really helped strengthen the balance sheets of the private sector and moved a lot of the risks from the private sector to the public sector balance sheets. And as a result, we actually had a recession where the private sector in a lot of countries came out of it better than it was going into it. And that's really, really unusual. And it's one of the reasons why we've seen this consistent theme of resilience around the global economies, that the stimulus was so significant that as a result, households and businesses are really in a good position. And this is also one of the reasons why a lot of the relationships that we're typically looking at have been taking longer to play out. So I think one of the uncertainties is, are they going to play out and is it just a longer story, or actually are some of these relationships a bit broken? Now, of course, that really did lead to that spike that we saw in inflation, and of course inflation spiked to the highest levels in many decades across most developed economies. Now, the positive sign is that we are definitely on the other side of that, and inflation is really coming down, particularly headline inflation, as those supply chain disruptions and commodity price spikes that occurred during Russia's invasion of Ukraine really pull back, and goods prices really come back as well. But it's particularly the core inflationary measures, which are still actually proving to be quite sticky, depending on which economy you look at as well. In particular, I guess Europe is looking a bit more of a concern. And that's really going to be the area that central banks are, of course, watching very closely going forward. And that's going to be potentially proved to actually be more difficult to get down than people expect. And of course, central banks have been reining a lot of this stimulus back in with some of the fastest increases in interest rates that we've seen forever in some cases, at least since inflation targeting began in the early 1990s in Australia. But I want to make a point that it's not just the front end of the yield curve that's increased, and it's not just policy rates that are important as well, but the entire yield curve and whether interest rates are sitting in positive territory from a real perspective. And you can see on the chart on the right-hand side that real interest rates across many key economies are now meaningfully positive and around that sort of 2% level for the 10-year real rate, depending on how you measure it in the US, and similar in Australia. So that does mean that monetary policy is definitely in a contractionary setting at the moment. If you think about where the long run neutral rate is, it depends on which economy you look at, but it's probably around 1% or less for developed economies, given that their growth potential is not necessarily that strong. So with real rates around 2%, that's definitely meaningfully restrictive, and that's placing pressure on aggregate demand in the economy, which is of course what central banks are trying to do. Now, going forward, as I alluded to, it's really services that are going to be the key issue. Goods have actually now been in disinflationary territory or in outright deflation in some cases, and that's helping to bring the inflation rates down, in addition to the base effects, given that, of course, inflation is starting from a very high point. But that will eventually wane, and I'll get to that in a second, and it's really going to be the services side of the economy that will need to see some progress to be confident that inflation can get back to central bank targets in the long run. And that's also because services inflation tends to be more sticky than goods inflation for a range of factors. Partly it's that wages make up a larger share of the costs of delivering services, and as a result, services inflation reflects more domestic labour market and domestic demand conditions, and we know the labour market is of course still incredibly strong around the world. And also services prices, once they do get going, it tends to take time for them to actually come back down because of some of those factors. So if we look at what's happening around the world, the US really has been leading the cycle, and encouragingly you can see there that goods inflation is now immaterial, and if anything it's likely to turn into outright deflation soon, and energy is also in outright deflation, which is a real positive. But really it's that core services ex-housing and housing which is really causing the pressure. In fact, if you just took basically housing, you'd already be above the US's 2% target. If we look at what's happening in Australia, these themes are similar, but there are some nuances. If we look at core services ex-housing, that is also a worry, and it's one of the largest contributors to inflation at the moment, and we'll have to see how that plays out. That will potentially be a worrying sign for the RBA. Core goods, we are seeing that disinflationary trend in goods play out, but it's taking longer here than it has in the US. And housing is another story here, which will also be a concern going forward. Initially, it was the cost of building new homes because of supply chain disruptions. Now it's rents. We're seeing the drivers of housing inflation shifting, but really housing inflation is still going to be a key driver of inflation overall. If we look at some of the key differences between us and the US, I think the one that stands out the most is really energy. Energy prices in the US are contributing to deflation, but here we know that electricity prices have spiked very significantly. Gas prices are going to be elevated as well, and fuel prices are also staying elevated with the weak Aussie dollar. So it is likely that energy will actually be a pretty significant contributor to inflation, particularly once government subsidies roll off, and because they're actually keeping that component of inflation artificially low at the moment, given they're flowing through to households. And it's really that last mile of inflation that is going to be the most difficult. And it's going to be the most difficult both because of all the factors I just talked about services inflation, but it's also going to be really difficult because the disinflationary pulse with goods will eventually run out, and goods will eventually stop contributing to disinflation and actually start adding to inflation again. Now, this process will still take some time to play out. Probably got about 6 months or maybe more for that goods disinflation process to play out in Australia. But if you look at some of the leading indicators, we can see that there are some signs that we are maybe getting a bottom. If we look at pricing indicators in the US PMIs for manufacturing and services, we can see that those prices for the manufacturing sector, they're still contracting, but not at the same rates as they were before, and the trend is clearly higher. And services prices did worryingly actually tick up in the latest read. So that's definitely an area to watch to see how that process continues. The other key point is that commodity prices, while they have pulled back a lot, they are now starting to increase again. And oil is really the key standout, reflecting both stronger demand, given that growth in the US is surprising to the upside, but of course the cuts in supply from particularly Saudi Arabia and Russia and the OPEC nations. So we've now seen oil move from those low 70s into the 90s. And if that holds up, then again, that will contribute to higher fuel prices. And of course, that's important in the supply chain of pretty much every good and service. So what does this all mean from a big picture perspective for inflation and for interest rates? Well, what it means is that inflation will come down, but it won't come down as quickly as people may hope. So we are seeing that inflation has already come off since peaking in Australia in the December quarter of last year. And the next couple of quarters, we're likely to see some pretty significant falls in inflation. And again, that's that base effect coming through. But once that filters through, getting into that 2 to 3% band will be a bit challenging. So we don't actually expect that to occur until around mid-2025. And the RBA is even a little bit more pessimistic, and they're expecting that to occur at the end of 2025. So what does that all mean for interest rates? Well, as I mentioned earlier, of course, central banks have raised rates very aggressively, and we are near the top of the hiking cycle around the world. For the Fed and for the US, financial markets are still pricing a decent chance of one more hike, not at the September meeting, but at the meetings later in this year, and have about a 45% chance of one more hike priced. And then beyond that point, they're looking for cuts through next year. But I think the key point to make about the US is that the shape of this market pricing for interest rates has actually changed quite a bit over the last few months, and markets now don't expect as aggressive a rate cutting cycle in the US as they were pricing before. So they're really sort of getting that message from Jerome Powell and other members that interest rates are likely to remain higher for longer. It's taken time for that to flow through and show up in bond expectations, or interest rate expectations, but now we're seeing that play through. For Australia, it is very likely that the RBA has now hit a peak in interest rates. Financial markets are sort of expecting there's a risk of one more, but it's priced only at about a 30% chance or so. And our view is that we also think that the RBA has actually reached a peak. We would say that the risk is to one more hike, but we wouldn't say that's our base case. But looking forward, I think the key point is that interest rates are likely to remain higher for longer. Financial markets actually now are not expecting a full cut to come through from the RBA until 2025. We're expecting it to come a little bit earlier, probably in the third quarter of next year. But that's still pretty much an entire year away. And I think the key point here is that if inflation in Australia does prove to be stickier than expected, given the communication that we've heard from the RBA, they will probably err on the side of leaving rates where they are for longer, rather than perhaps hiking again, because of course they're trying to walk that very fine line between managing growth and getting inflation down, while other central banks are sort of targeting getting inflation down a bit more aggressively. So if anything, you may actually see the cash rate remain at this level for even longer than our current expectation if inflation proves sticky. Now, so what are some of the key drivers of inflation at this point, and particularly services inflation? I think the labour market is really the important area to watch for Australia and around the world as well. And those labour market developments are, of course, extremely closely watched by central banks. What we're seeing is that labour markets are still very tight, not just in Australia, but globally as well. And again, this was a real theme around the world, the outperformance of labour markets during the pandemic, and the fact that that, of course, flowed through to stronger household incomes, at least in nominal terms, not in real terms, given inflation was so high. And that helped to support growth. So this is one of the drivers and one of the reasons why growth has been more resilient than we previously expected. But we are seeing those unemployment rates tick up, but you can see on the right-hand side chart that it's from levels, decade low levels, or in the case of Australia, almost the lowest level in almost 50 years. So again, this is expected to be a gradual process rather than a rapid one. If we look at the Australian labour market, we can see that the market is easing as many of these, as we're getting a better balance of supply and demand in the labour market. So what's actually been driving this easing at the moment is that the growth of the population has been running at record levels. So basically, there's more supply that's being added into the labour market than demand. So the growth in the population is outpacing the growth of employment. And what that means is eventually those people that are coming into the labour market are going to find it more difficult to get a job, and we're going to see the unemployment rate increase gradually. And we are starting to see that process play out, but again, it's coming off of those extremely low levels. And we expect that to actually be the main driver of the slowing in the labour market through the rest of this year and into next year as well in 24. But the other factor is that demand for labour is also going to come off, but that's not expected to be the main driver of that slowing in the labour market. We are seeing that demand starting to ease already, and you can see that in job vacancies and job ads retracing a little bit from some of those record levels, and also applicants per job ad have been increasing as well, which again reflects that supply side story. With regards to the unemployment rate, we are expecting a gradual increase through this year to about 3.8% by the end of the year. And then for next year, again, we're expecting a gradual rise through the course of 2024, with the unemployment rate hitting around 4.7% by the end of 2024. Now, the other key question here is, for Australia is what is going on with wages growth? We have seen that as the labour market has tightened, nominal wages growth has picked up, which is of course consistent with what we would expect, but that pickup hasn't been as strong as was initially expected or as strong as what we saw in other countries. So wages are now growing at about 3.6% over the last 12 months. So in fact, most of that strength in the labour market flowed through in increased hours, which you can see on that middle chart. And that was both a reflection of increased employment and people shifting from part-time work to full-time work. And this is in contrast to what we've seen in other countries, particularly the UK, but the US and other countries as well have seen wages grow at levels that are not consistent with inflation getting back to target. In Australia, that's less of a concern, but of course, productivity has been something that the RBA has been mentioning quite a lot. So these wage growth levels are okay if productivity picks up, and unfortunately, productivity growth has been pretty weak. So that's, again, an area to really monitor going forward. And for households, while nominal wages have been increasing, the key challenge is that real wages growth has been extremely negative. In fact, real wages have been falling at the fastest rate in history, given the spike in inflation late last year. On top of that, not only are households facing pressure from inflation, but they're also facing pressure from increased tax payments as higher nominal wages growth pushes more households either further into the tax bracket that they're already in or into another tax bracket, so it increases average tax rates. And of course, mortgage repayments as a share of total household income have also been spiking given the increase in the cash rate. So in fact, scheduled mortgage repayments, so both principal and interest, have risen to their highest levels since the GFC, and they're expected to actually rise further to just a bit under 10% of household income. So just to put that into context, the RBA estimates that that's actually going to be the highest level in history, even higher than in the early 90s when interest rates were 17%. So that really just does demonstrate how much pressure households are under. And the reason why those payments are expected to continue to rise, even if the RBA doesn't increase rates, is of course the fact that we've got a large group of households that are shifting from fixed rates to variable rates. So they'll be going from interest rates of 2.5% to 6.5%. So during the pandemic, we did see a lot of households take up that opportunity, but they will be rolling off eventually. And you can see this in the left-hand side chart, which shows the change in rates for owner-occupiers. The green line, for example, shows that interest rates have actually only risen by about 2.8 percentage points compared to the cash rate increasing by 4 percentage points. And that is reflective of those fixed rates. And in fact, even for variable rate holders, the burden of interest rates hasn't been as significant as the cash rate increase, and that reflects competition in the mortgage market, particularly through the cashbacks that banks were offering. So again, those lines will gradually rise going forward and put more pressure on households. If we think about a couple of things that are moving in the opposite direction, household savings and household wealth are really the two key drivers moving in the opposite direction. During the pandemic, of course, households built up an incredible pool of savings, given both the stimulus that I mentioned earlier and that spending opportunities were limited or non-existent in many cases. So household savings jumped to around $260 billion, in excess of what would have otherwise been there. And now households have started digging into that pool of savings. And what they do with those savings is a key uncertainty around the economic outlook. If they run it down quicker, then the economy is likely to grow faster than we expect. Otherwise, if they hold on to it for precautionary reasons, then you may see growth disappoint. And of course, the asset markets have been another supportive factor, with house prices now back on the rise again. Now, I just want to touch on some of the differences between us and other countries. A lot of these factors are very similar in other countries, but there are some important nuances. So one of those nuances is that in Australia, most households actually have variable rate mortgages. And even during this period where fixed rates did spike, you've still only got about a third of households that are on fixed rates at the moment. And that does differ compared to other countries around the world. And the US is really the strongest example where households have fixed rates of 30 years, and most households are in that position. So this is one reason why the RBA actually hasn't had to increase interest rates as much here as other central banks have overseas, because the mechanism, the pass-through mechanism to household income is faster in Australia than it is in other countries. And the fact that wages haven't been growing as quickly is another key reason that I mentioned earlier. On savings, the broad story is very similar in other countries as well, but what households have done with those savings and how large they are does differ a little bit. So you can see really the US, again, they've been leading this cycle by about 6 months. So they've already actually run through their excess savings, and now they're just digging into their overall savings pool to support their consumption growth. Now, if we look at some of the leading indicators around the world and what they mean for GDP growth, we can see a very divergent picture across the manufacturing sector and the services sector. For manufacturing, the manufacturing sector has really been in a prolonged recession, not just in Australia, but in these other key economies such as the US, Euro area, et cetera. And this has been a theme throughout all of 23 and much of 2022 as well. And that has been flowing through to weaker growth, but again, those relationships are perhaps a little bit longer at the moment than they were in the past. The services sector, on the other hand, has really shown that resilience. And that's really reflective of all of those factors that I talked about before. But in the latest data, we are seeing that the services sector is starting to crack as well. It's moved into outright contraction in the Euro area and in the UK, and it's likely to continue to weaken. But I think these are the other points of data that kind of show that difference between the US as well, which keeps surprising to the upside, and what is one reason why people think there's going to be a soft landing there. So you can see that services sector activity in the US is holding up, and manufacturing sector activity is also improving faster than other countries. So that will be a key area to watch as well. So going forward, what does this all mean for global growth and Australian growth? So overall, we expect global growth to be quite weak this year and next year as well, under the weight of this significant tightening in monetary policy. But we don't necessarily expect a recession in Australia or in the US any longer as well, given that the US has been outperforming more recently. For Australia, we're looking for growth to average about 1.2% over 2023 and then pick up a little bit to 1.6% in 2024, particularly in the latter part of that year, as we think the RBA will be in a position to cut and the tax cuts will come through as well. But that's aggregate growth. I think one really important point to make here is that, of course, population has been running at record levels. So if you actually strip some of that strong population growth out and you look at per capita numbers, they're actually looking quite sick. So we've already entered a per capita recession in the latest data that was released earlier this month. And we're actually expecting per capita growth to be negative through all of 23 and all of 2024 as well. So that will be the longest per capita contraction in history if it occurs. And it really does demonstrate just how much pressure the Australian economy is under, and that for most people, even though it may not be a recession in the numbers, it will certainly feel like one. Now I just want to touch briefly on China and also on the Aussie dollar before I turn to some questions. We did talk a little bit about China in some of the sessions earlier, which, in some ways it is the elephant in the room, with growth out really disappointing to the downside after that short-lived boom earlier this year as China lifted those COVID-0 policies. So we did see services activity and manufacturing activity pick up, but it's really come off in recent quarters or recent data points as well. And on top of that, we've seen that price growth has been quite weak. So China actually has the exact problem to the rest of the world. They've got zero inflation or even outright deflation last month. And that really does reflect that weak domestic demand. And their producer prices are also going backwards, which does reflect weaker demand from the rest of us and weaker demand for Chinese exports as well. Now, one of the positives is that this will flow through into slower inflation growth, which is a positive, but it really does reflect the weakness in the Chinese economy. And what that is largely reflective of is the drag that we're seeing in the residential property sector. Of course, the residential property sector has been under a lot of challenges over the past couple of years. And part of this really goes back to some of the reforms that the Chinese government has put in place many years ago to try to reduce leverage in that sector, try to reduce risk in that sector, and try to transition Chinese growth away from sort of export-led growth and property-led growth more towards domestic consumption and domestic-led growth, which is more similar to what you see in developed economies. So, of course, the government introduced the 3 red lines policies a couple of years ago, and we saw Evergrande, was really a key example and defaulted on many of its loans a couple of years ago, and now we're seeing Country Garden go through that same process. So it's likely that property will continue to be a bit of a drag for the sector. A lot of people are waiting for stimulus to come, and while some stimulus measures have come through, and more recently, particularly those reductions in deposit requirements and interest rates for people purchasing homes, the big stimulus that was expected was fiscal stimulus, and that really doesn't seem to be coming at the moment. So I think going forward over the next few months, it will be important to see how authorities react to this weakness, and that will really determine how their growth path will sort of play out over the rest of this year. And of course, one other point to make is that confidence is weak in the Chinese economy, and part of that does reflect very high unemployment, particularly for youth. So, of course, you might remember the youth unemployment rate is running at over 20%, and in fact, it's so high that the Chinese government stopped publishing it. So, they've got the luxury of just not publishing data they don't like. But it really does demonstrate the challenges that economy is going through, and that the reaction from authorities will be key to watch for the rest of this year. The other point I'll make just before I pause for questions is the Aussie dollar, which has been under a lot of pressure over recent months. And there's a couple of factors that are playing into this. And I think when you think about currencies, it's important to think about the 3 key drivers of currency movements: interest rate differentials, risk sentiment, and then growth rate expectations and growth differentials as well. So across pretty much all of those factors, we've seen some negative news over recent months, which has placed downward pressure on the Aussie. For interest rate differentials, of course, markets are now expecting that the RBA is probably going to be on hold, while with the US surprising to the upside, they may still have further to go. So we've seen the bond yield spread between Australian and US bonds narrow a bit, so that's placing downward pressure on the Aussie. And on risk sentiment and growth expectations, I guess it's really a China story there. Australia is, of course, a big proxy for Chinese growth, and what happens in China really does have important implications for Australian growth as well. So again, that bad news is flowing through the bad news here. Now, going forward, I think there's likely to be quite a bit of volatility, and probably needs to be some significant catalysts for the Aussie to move in either direction. If you do see China announce some significant stimulus, you'll probably see a bit of a rally. But some of these pressures are still likely to weigh on the Aussie. Looking further forward, though, through 2024, we do expect gradually some of these themes to unwind and the growth story to be a bit more positive, relative growth story, relative interest rate differentials to be more positive for Australia as well, and for risk sentiment globally generally to improve. And that should lead to a slight increase in the Aussie through next year, but we're looking for a target of around 70 cents at the end of 2024. So overall, it's still a picture of general weakness for the Aussie. And the final, I guess, question is, well, what will the RBA do in reaction to this? Of course, a weak currency does impact inflation through imported inflation, but the RBA will likely be looking at the trade-weighted index, not just the Aussie dollar versus the US dollar. And if we look at the TWI, we can see that that is low. It is around the bottom of the range that it's been in for the last couple of years, but it's still within that range. It's sitting at around 60. So that probably does mean that the RBA will look through some of what is happening at the moment with the Aussie. But if we do see it crack a lot lower, and if you do see the TWI go quite a bit further, then maybe that will mean that the RBA needs to think about this a little bit more and think about what that means for imported inflation. But I think at this point, they're probably going to sit on their hands, but of course, it's a wait and see. So thank you, everybody, very much. I'll just also quickly put up the obligatory disclaimer slide, just basically saying when you see me next time and things have gone a little bit differently than I said, then you can't hold me to it. So I'll just see if there's any questions.
Yeah, thanks. Great session there. The Indian economy. In fact, I was at economy breakfast before coming here, and one of your colleagues was talking about the Indian market. It'd be interesting your view of the Indian market and the impact on our growth here in Australia.
Yeah, that's interesting. So I guess, India is, longer term, I think it's going to be, more and more of a powerhouse in global economic growth. I think one of the really key advantages that India has is that it's got an extremely young population relative to China, in particular. I think one of the key challenges for China going forward is that their demographics are now starting to turn to be a bit negative, and are likely to be a bit of a drag on economic growth in the long run. While India is still in that stage where they have a very young population, in a relative sense, so that is expected to continue to really sort of support growth for the Indian economy. And I think their place in Asia is likely to continue to strengthen as well. Of course, there are some tensions between India and China, which are likely to continue. But I think with India's growth, you will see the importance of that economy within the Asian region, within the Asia-Pacific region in particular, continue to strengthen. And of course, India has quite close relationships with us and the US, while the relationship with China is becoming a bit more fractured. So I think the strengthened relationships with the Western world will also likely improve India's position within the region as well. For Australia, I think the direct relationship that we have with India, I think, is most evident in exports of services, given that Indian students and, of course, Chinese students are the biggest group of international students that come to Australia. So I think that will continue to be supportive for Australia, and we're seeing closer relationships with India, with the Prime Minister of Australia meeting with Modi as well recently. So I think that relationships will likely to continue to strengthen.
Jarek, I've got a question about about migration. I mean, most migrants are working age people. We're bringing, migration here is sort of between 250 and 400,000, which is sort of between 1% and 3% of the adult population. So when you predicted a growth in unemployment, we're not talking about it going from the current, 3% to 10%. We're talking about an upturn. What's the chance that, in fact, a bit of recession here, a bit of downturn in the labour market means a bit less migration, therefore, less effect on unemployment?
Yeah, that's an interesting question. I guess what you actually normally typically see is Australia's migration is sort of demand driven, and you do see when Australia's economy is doing quite well, that's typically when overseas migration improves very significantly. So I guess the last time that migration got to these sorts of levels was around the time of the GFC, just going into that period when, of course, the mining boom was still helping the Australian economy. So that really did flow through. I guess in some ways what's happening right now is kind of unique because the Australian economy is actually going through quite a period of weakness, and migration is still running at incredible levels and at record highs. So of course part of that reflects the catch-up that we're seeing, and that Australia is still a very desirable destination. I think in some ways the demand from overseas for people to move here is probably unlimited, and it really depends on the settings that we want to put in place as to how restrictive we want to make those migrant settings, and what sort of levels of education we want to demand of people that are coming here, and income and so forth. So I think in a lot of ways it's probably going to be reflective of domestic settings. But you're right, if the global economy slows more than we expect and the Australian economy slows more than we expect, then that will make it slightly relatively less attractive. But I think it's probably going to be at the margins, because I guess while it will be less attractive for one person, it will probably be more attractive for someone else. So you're probably just shifting who's likely to come, unless you get significant policy changes from the government, which changes the ability of people to come.
Jarek, a question about the RBA. We've got a new governor, and then there's going to be this new monetary policy board, I think they're calling it. Just wonder if you think that's going to make any difference to what they focus on, or what policies levers they might look at in the future.
Yeah, I guess that's a good question. I usually try to stay away from those sorts of questions because they are a bit political. But I mean, I think it is the changes that are put in place are interesting, and having people on the board that have more economics understanding and more of that sort of background, I think in some ways will be helpful because they'll be able to challenge maybe some of the research that's coming out of the RBA. But then in other ways, the current board structure has benefits which the governor's talked about, in the sense that you've got business people who have a better understanding of maybe the real situation on the ground, rather than maybe thinking a bit more theoretically, like economists may tend to do. So I guess there's pros and cons of that approach. I mean, I think at least in the near term, I think it's probably not going to be a gigantic change, because the shift is a pretty marginal shift. You're still going to have a board. You're still going to have that board coming together to make those monetary policy decisions, and you're still going to have the RBA staff being able to provide analysis and information and their forecasts to that board. So I think it probably won't be a gigantic shift, but I think it is a marginal improvement from the perspective of transparency and also helping board members become more informed, because they're going to have more access to the RBA staff themselves. So hopefully, in the long run, that will prove to result in better decision making. But yeah, I think it's probably going to be a marginal change at most. All right, thank you, everybody.
All right, look, thank you very much for your time and attention today. It's been a pleasure for us to be able to host today's Independent Thought. I hope you've taken something out of it. I've taken a couple of things. Jarek, who is an economist, thinks it will be a good thing if there are more economists on the board of the Reserve Bank. The first session was somebody who pointed out that we all think active management is a good idea. I took the phrase quant winter from Stephen Tang's session. So there was something in it for me, and I hope for you too. So thank you for your attendance today. I hope you found it worthwhile. We welcome your feedback. You'll get a SurveyMonkey thingy to fill it in and send it back. But we also welcome any additional comments. Just send them back to Jenny or myself, or to support, of things you think that would be of interest or relevant for IMAP to talk to you about. We have a really interesting program worked out for 2024, and in particular for us to focus on taking very specific managed account program education and training to advisors within licensees. So thank you to Jason for your excellent job today. Jason, you offended almost no CFAs in Sydney. And of course to the other participants who took part today. So thanks for coming along. We look forward to seeing you all again soon, and go the All Blacks.